Good morning, everybody, and welcome to our very first webinar for 2018. Now, in this year, we again have planned monthly financial reporting and accounting webinars. And if you specifically look at this webinar, you'll see we'll start with 2018. The wait is over. We've been waiting to implement, to transition to these new accounting standards, and the time's arrived. We'll also be looking at IFRS 15, revenue from contracts with customers. We'll look at IFRS 9, financial instruments. We'll look at IFRS 16 on leases, as well as AASB 10 58, specifically for our not-for-profit attendees. We will end the webinar by looking at some next steps and then also asking you whether you need any assistance. So please keep that at the back of your mind. Make some notes if you need further assistance and about what you need further assistance. However, before we go any further, I would like to welcome Kevin Frobers to our BDO webinar team. So you'll remember that last year, this was a solo show. But this year, I've got a friend joining me. So Kevin will be presenting with me. Today, we're together in Melbourne because we have to sort out how we're going to work together and run these webinars. But Kevin is actually based in Sydney and therefore looking after all our Sydney clients and contacts. I've given you there his email and his telephone number. So Kevin, nice to have you here.
Thank you very much, Aletta. It's really good to be here. Aletta and I have known each other for quite a long time, and it's actually good that we're finally working together. And I think the Sydney client and the Sydney office of BDO are very thankful to have a dedicated IFRS resource in Sydney. Not a moment too soon for the new accounting standards.
So, thanks, Kevin. So if we get straight into it and look at 2018, the wait is over. And you'll remember in our monthly accounting newsletters, we have been talking about these new standards. We also did a countdown. We were counting down the days to 2018. And finally, it's here. So if you're a for-profit entity, you'll be interested in the triple threat accounting standards, and they are IFRS 15, 9, and 16. And if you look at the effective dates for those, IFRS 15 and 9, the effective date is 1 January 2018. So if you've got a 31 December year end, the end of this year, definitely you have to apply these two new standards, and leases a year later. If you've got a 30 June year end, you've got 6 months longer to get ready. And the first year for 9 and 15 would be 30 June 2019. However, you can see we've really now, we're now really at a crossroad. We have to work on this.
Yeah, Aletta, I'd like to just make the point on the for-profits. This realization has dawned on a number of our listed clients that although the effective date for, let's say, December year ends is in the December 2018 financial year, for the listed entities, they need to report half-year results in June. So really, if you're a listed entity, you've only got, let's say, 5 months left to go before you need to announce the effects of these new standards in your half-year results. So that's just something to keep in mind.
Correct. If we go on to the not-for-profit entities, they actually have 4 new accounting standards to deal with, because they have to decide whether their contracts are within IFRS 15 for revenue recognition or within AASB 1058. And as I've been working with not-for-profit clients over the last year or so, I think the tricky thing for not-for-profits is that you have to make that assessment on which standard is applicable, IFRS 15 or AASB 1058, on a contract-by-contract basis. You cannot decide that for my whole entity, I'm just going to apply IFRS 15, or everything is within AASB 1058. Therefore, for not-for-profit entities, it's important that they update accounting policies, they have a system or a process to consider every contract on where do you end up for revenue recognition. On top of that, not-for-profit entities have to deal with IFRS 9 and also have to deal with IFRS 16 leases. And you will remember when we look at IFRS 16 leases, there's that interplay with the new revenue standards around peppercorn leases. Again, a complex area, and I've given you some dates there to remind you. I know a lot of our not-for-profit entities have 31 December year ends.
So an observation for our not-for-profits, I get a lot of questions from the not-for-profits focusing on the leases standard, which is really looking at the concept of peppercorn leases. But really just need to remind you that in the not-for-profits, the revenue standard and the income standard go first, or you need to really look at implications arising from those first. They've got an earlier effective date. Don't lose sight of the complications that come with the distinction between revenue and income. As Aletta said, it's not a policy choice to choose one or the other. It really has to be assessed based on each of your grant contracts or whatever type of agreement you have. And perhaps you really need to focus on that before devoting an extensive amount of time on the leases standard. Just a point to take note of.
I think the other thing to highlight here is the effective date of IFRS 15 for not-for-profit entities is actually a year later because they've given us the application guidance.
That's right.
So that table, IFRS 15 should be 1 January 2019. For IFRS 9 financial instruments, that's the one that's actually first cap of the rank. Yeah. You're absolutely right, Kevin, on not-for-profit entities. I think we could say, so why now? I think we all know why now because we're there. So if we are looking at why now for 31 December year ends, you are actually already today, January 2018, you are within that first year. You are within the current year where you've got mandatory application if you're a for-profit entity for IFRS 9 and 15. So you're already there. So definitely 31 December year ends, we have to make some work of it. For 30 June year ends, today we are still in the comparative year. The mandatory application will only kick in on 1 July this year, so you've got another 5 months. However, you have to get ready. And again, these dates are focusing on for-profit entities, slightly different for not-for-profits. Before we move on, I would like to start, as we always do, we have some polling questions, and I thought let's do the first polling question. What is your state of readiness? What is your state of readiness for transitioning to these new accounting standards? So I don't think it will have an impact. I've only attended training, some internal discussions. I've assessed multiple scenarios and identified transition needs. I've appointed an external advisor. So just maybe a time at the beginning of 2018 to just make an assessment where you're at on this journey. Again, as always, it would be nice if most people participate and give us an idea. We are getting people involved. At the moment, we've got around 57% of people have voted. I'm looking for at least 60%, so we've got meaningful results. That would be good. And then I'll share the results with you.
And as the results are accumulating, it's interesting to see where they're heading in terms of the selection. If you're actually finished with your transition, just click the fourth option, assess multiple scenarios, if you've actually finished your transition, just so we get an indication of roughly where you are.
All right, so fantastic. At this stage, 76% of people have voted, so I think it's time to close the poll and share the results, and this would be interesting stuff. So 9% of our attendees have said, I don't think it will have an impact.
It's probably the number one comment that I received last year when I used to speak to clients about the new standard. And I think the message to you on that, I don't think it will have an impact. We've probably arrived at that point where it's time to back that statement up. And what we mean by that is perhaps we need an actual formal assessment or show us some data that actually proves that statement. But I am interested to notice that that has dropped, and we actually moved into the other categories, which is attended training, and got some had some internal discussions. That's roughly where I thought everybody would be, and that is the case.
Yes, I really think it's interesting. If you've only attended training so far, if you've had some internal discussions, I really urge you to step it up to the next level, which really is you have to assess internal multiple scenarios, identify your transition needs.
Yeah. The message coming out of this, as well as the message that we'll share for the rest of the year in our webinars, is that it's time to move from the information gathering stage into the actual planning and risk assessment stage. And that's maybe a good intro into the next slide that you have, Aletta, on the format of how we'll do these webinars going forward. The process that we're going to adopt in our webinars and the approach that we're taking in IFRS advisory this year is to actually take us away from information and information gathering to actually doing proper planning, risk assessment, and to assist you with project managing this transition, because we really are now looking at an implementation stage for these standards.
So for those of you that's been doing these webinars on a regular basis over the last year, I'm taking you to our website where you can see our webinars for this year that's been scheduled. And you'll see at the bottom, we've got the webinars that we did last year. Now, if you go down to the 2017 webinars, it was all around overview and information. It was overview of the new IFRS 16. It was around AASB 1058, overview of the new standard. We looked at the new AASB 9 or IFRS 9, and we broke it down into classification, impairment. We looked at hedging in December. We ended the year with a bang. We also provided you in June an overview of IFRS 15, and then we had webinars where we looked at each and every step. So I would say in 2017, the focus of the webinars has absolutely been setting the scene, theoretical knowledge, sharing the theoretical knowledge. And as Kevin said, if you go up to the 2018 webinars, you will see that we're now stepping it up a gear. And we want to talk about the new standards, but particularly the problem areas, the risk assessment, the transitioning. All right, so we're back there with the slides.
Right, so looking at transitioning, what does this actually mean? Couple of points on this. The first issue is a misconception that we've noticed in the industry about how to transition to these new standards. Now, traditionally, when you adopt new accounting standards, you do the retrospective approach, prior adjustment, restate your comparatives, provide disclosures. The first misconception we've noticed is that there is a modified retrospective approach in the standards, and I'm referring probably more to IFRS 15 when I talk about the modified retrospective approach. And on a very high level basis, what it allows you to do is, instead of restating your comparatives, you actually do a cumulative adjustment in the current year or the year of adoption, and then you move forward. The misconception that we've noted is that many entities are starting to see this as a prospective option. So what they're thinking is, well, we don't have to go back, we don't have to look to the past, we just worry about this going forward. And that's actually not true. It's still a retrospective approach. It's just a modified retrospective approach. So the misconception is that this is less work, less calculation, less to be done. That's actually not true. It's really just in the presentation and the disclosure where there's relief. You still need to go back into the prior years. You still need to identify contracts that are affected by the new standard and actually do the calculation and the work. It's just how you process that adjustment into your financials that's different. So that's the first misconception in the industry, and we'd like to just point that out because one of the first sessions we'll do, I think it's the very next webinar, Aletta, we'll do, is we'll start to look at transitioning, so that you need to understand that you're effectively going to be running parallel systems over this transition period, from what you're currently doing to what the standards would look like based on your in your prior periods. The other thing to start looking at is, what does transitioning mean? Transitioning meaning is not just a compliance calculation. Now, some of the clients I've worked with who've actually done this exercise, I think they still look at this as the concept of an overlay or a compliance calculation that you can just put on top. So many of them are still heading towards Excel spreadsheets. Let's try and work out the calculation and figure out what the adjustment is. But what they're actually failing to identify is that moving to these new standards is actually a business change. Instead of recording transactions under IFRS 15, every time you sell a unit or provide a service, it's actually more about assessing the contracts, breaking the contracts into components, and actually making your adjustments from there. So many entities are finding that their IT systems and their accounting packages can't cope. So you actually need to look at this transition process as a project management approach. How are you going to do the risk assessment, and how are you going to plan your responses to what you find as part of your risk assessment process? How are you going to move from just understanding the technical components and moving towards design and implementation? My recommendation to you, and this is based on some of the clients we've worked with, is that even some of the medium clients are looking at a 4 to 6 week plan just to do the risk assessment stage. So that's just to understand, what are the implications? Who do I need to involve? How am I going to do this if I'm not going to run it in Excel? And then what are the policy gaps, and what are the decisions I need to make even before I start to figure out what the adjustments are and how I'm actually going to implement? And that's the theme we'll be running with through this presentation as well as the rest of the year. If your takeaway from today's session is the only thing is, how do I transition? It's to start to look at this as a project management business process, as opposed to just a compliance exercise at the end.
So if we look at these individual standards and just recap on these individual standards, IFRS 15's got to do with revenue. So that's an important, a significant number. And we know there's a lot of sensitivity around this number. And we know that the current revenue recognition model, as outlined in AASB 118, is being replaced by a new core principle, which is that you recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects. We always circle the word expects to be entitled in exchange for those goods or services. And it's important that we realize that customer is a party that has contracted with an entity to obtain goods or services that are an output of an entity's ordinary activities. So revenue is only recognized in relation to ordinary activities, and we need contracts in place. So this is an overall core principle which I think everybody will start their revenue recognition accounting policy with. However, we then have to move on and say we have 5 steps to apply this core principle. The first one is to identify the various contracts with the customer. As part of step 1, we have to consider whether we'll combine the contracts with the customer, and we also have to consider potential modifications to contracts going forward. After we've done that, we have to look at step 2 and identify the separate performance obligations or my separate promises. In step 3, we look at the total transaction price. In step 4, we allocate that total transaction price to the performance obligations identified in step 2. And then only when we get to step 5 do we recognize revenue when a performance obligation is satisfied. And that could be at a point in time or over time. And there are very strict rules on when would it be able to be overtime, because the default is that we recognize it at a point in time, and a lot of guidance on when is it at a point in time and how do you determine the point in time. I think what's important when dealing with clients and speaking to clients about that, some people jump into step 3 and then go back to step 1 and then go to step 4, and they jump all over the place. And I keep on saying to them, it's really important that you stick to the 5 steps in this exact order. If you jump in at the wrong step, you get your answer wrong and the whole thing is all muddled up. You have to first of all know what are the relevant contracts and whether the contracts should be combined or not, because obviously that impacts what your total transaction price is. So important to stick to this formula and this order.
If I could make a comment on that, when I sit with clients or really anybody who wants to talk about the standard, I actually have created in my mind a step 0. There's actually a step before step 1, and that's understanding how you make your money. And that's really what we call the business model. And it's maybe a piece of information that's useful if you're looking at this for the first time. When they developed the standard, there was actually a heated debate at the international level on whether they should actually include a business model approach in the standard. And that's what I refer to as step 0. And step 0 actually says to you, how do you make your money and how do you sustain making money? What are the strategies that an entity employs to, first of all, find the customer and then contract with the customer? So the step 0 is, what do you do to find a customer? What are you prepared to do and give away to make the money? And what are you prepared to do and give away on an ongoing basis to keep that customer? And that's where things like giving discounts come into it. If I'm prepared to give a discount to you, 10% discount on the unit, if I'm prepared to give you a right of return that nobody else has, if I'm prepared to maintain the contract with you, I actually give you warranties. If the product doesn't work, you can bring it back and maybe I'll service it. All of those are strategies that entities employ to make money on an ongoing basis. And those are the basis for contracts with customers. That translates to what you have to do, your performance obligations, and how much you're going to earn. And the general principle that I'm finding with this standard is the moment you make a promise to a customer for future goods and services, which you haven't yet delivered on, you are going to have a portion of your revenue deferred until such time as you deliver on that promise. So this is where your sales representatives or really anybody who deals with customer relationships come in. If you make a promise to a customer and you say to them, for example, I'll arrange the transport once we've got the goods manufactured, we'll get them to your premises overnight. What you have done is you've promised an additional service, which means you either acting as an agent to arrange that service, but really a portion of your revenue that you've earned from the transaction gets allocated to that additional service and only gets recognized when you make good on that on that service. And I'll use the trucking example again. You might manufacture goods for a client, they're sitting in the warehouse and they stay there for 3 months, and then you arrange the transport for them to maybe get the goods to the other side of the world, to Asia or Singapore or wherever it may be. You have taken on the responsibility to arrange or perform the service of delivery, and that has implications under the model. It means that some of the revenue that you're earning from it needs to be deferred until such time as you act on that service. So that's maybe a good way to start looking at this. Start thinking about it as a step 0. What's your business model and what are you prepared to do to keep the customer happy, and how does that translate into your contract, your obligations, and how much you're going to earn at the end of the day?
So I think it's a good opportunity to maybe launch another polling question. And the question is, what do you think the impact of IFRS 15 will be on your business? So do you think it's a compliance exercise? Do you think it will change your business model? Do you think it will, there will be changes to processes and systems required or needed? Do you think you need a revision of agreements, or all of the above? again, we'll see if everybody can get involved and give us their views. So I think to those who've spent a bit of time on the training, had some internal discussions, you'll have quite a bit of a view on what this entails.
As the numbers are coming in, I think the message is starting to become clearer, Aletta, that there's a much bigger change from these standards and perhaps the work involved.
So I think we've got 65% of people have voted. So let's just see what people are thinking.
Yeah, that's very interesting. It's a compliance exercise is still at the top of the list. I would say that for some entities that might be true. Just caution against that. A compliance exercise, I think, is one of those things that as you're going along, the new model, in particular, the revenue model, can actually have some very, very good business uses. It can actually be a good business management tool. Changing the business model at 2% is absolutely correct. This should not change the way you do business, but rather it should reflect the way you do business. So that's absolutely true. Changes in processes and systems is absolutely true. From an IFRS advisory point of view, I think in many ways it can help you understand what those process changes are, but you are correct. Just managing the flow of information and how that translates into your financial records is important. One of the other things that we've come across recently is that the industry, the accounting software providers have woken up really late to the party, that the invoicing and payment milestone systems that we all use for transactions and revenue generation isn't necessarily the way IFRS 15 works. SAP have devoted an enormous amount of resource to update their systems so that this can then cope with the new system. I do have a little bit of story on revision of agreements. It's an interesting one that 5% have said revision of agreements. Last year, we sat in a room with a client and we took one contract and worked through it with them. And this was part of an exercise to help them understand the potential impact. So it was one of those, well, let's take one agreement and see what happens. And while we were working through the agreement, we came up with a particular way that we thought revenue might get recognized. And I remember the CEO jumped up and he said, "You don't understand our business because that's not how we earn our money." And I actually pointed out a clause in the agreement that the entity as a whole was not aware of. They actually didn't realize that the contract said one thing, even though they managed the relationship with another, such that they actually went back to the lawyers and all their agreements got changed because the contract didn't reflect the way they thought they ran their business model. So that was really interesting. For years, they had been operating with contracts which actually gave more power to the customer, and that had to be changed and renegotiated. So there are the other entities are going to change their agreements so that they can achieve a certain outcome with revenue. But that was a really good story of how do you know how your business model is reflected in your contracts, and actually does it give you the rights and obligations that you thought it did? All right.
If we look at the top things to do, or the top 5 things to do right now, and this is specifically looking at IFRS 15.
Yeah, I mean, I think probably covered the first one. And these are strategies, if you haven't started or if you've just attended training, is to actually just do right now. Small little low-hanging fruit that can start to move you towards implementation and design. And the one thing I said is to start thinking about it in terms of your business model. I think I've probably covered that one to a large degree. The other one is to read as much about the impact on your industry. And I'll admit this even from my own point of view. When you read the standard, it's dense, it's long, there's lots of pages, there's lots of examples, but you don't really actually see the impact until you actually get an example. And if you actually can pick up any literature on this, there's lots of literature on the internet dealing with the new revenue standard, in particular how it affects various industries. Just get a hold of that as much as you can and read those documents if you haven't already. The new standard is actually also being adopted. This is IFRS 15, is being adopted in the US. So there are a lot of organizations in the US that have put out specific guidance that that impact specific industries. And I think knowledge is power is really true in this scenario. The other one is a proof of concept approach. And this is something that really just revealed itself to me in the last couple of days. Take this process really slowly. Don't try and do it all in one go. And what we mean by a proof of concept approach, find a customer that you have an ongoing relationship where you've got agreements, where you know how you deal with that customer, and build a model just for that customer first. And then you can start to build on that by changing scenarios. And at that point, once you've got your proof concept for one customer, get your auditors involved, get your advisors involved, get people in the business involved, and actually just have roundtable discussions and actually just have a look at that one concept. So develop a proof of concept, start with one customer, one scenario, and then build on that over a couple of weeks. The other one is get some help. And this is whether you appoint an advisor, you get myself and Aletta to come and visit you, or even just get some help in the organization and delegate this if you can. Don't try to do it by yourself. Get as big a team as you can, because like I said, it's one of those things that's going to take some time. And the other one is make some decisions about automation. The best advice I think I can give is don't use Excel. If you're using Excel to at least understand the implication, that's fine. But unless you're a small entity with only a limited number of customer relationships and contracts that finish in a short period of time, trying to manage your accounting system in Excel to supplement your invoicing system really is going to get complicated because it's effectively running parallel systems. And I think the earlier you decide on how your automation will work, the better.
I know it's a little bit slow to come through on your screens, but I would like to take you back to our website, because on our BDO website, we've got industry heat maps, which basically means that we've gone through and looked at a number of industries, and based on work we've done with a number of clients, said, if you go to this particular industry, these are some of the main issues we've seen. And we've actually built the industry heat map to look at, for instance, retail, software, telcos, etc. And we said, what is the potential impact of the scope part of the standard? What is the potential impact of step 1, step 2, step 3, step 4, step 5? So you could see, if I'm in retail, potentially scope and identifying the contract and determining the consideration is not a big deal. However, the performance obligations, whether there's a discount involved, whether there's a gift card involved, could be a problem, as well as allocating that consideration. And I'm thinking flybys, I'm thinking Qantas frequent flyer miles, and then also when do we recognize the revenue? And that is just an example. So what we have at BDO is on our website for free. You can look at these high-level industry heat maps. If you just go up on that screen, and I know it's a little bit slow coming through, if you go to our website, IFRS Advisory for BDO, we've got different tabs for AASB 9, AASB 15, AASB 16. On each of those, we are giving you some help around implementation steps, industry heat maps, etc. And right at the bottom, there are also some fact sheets and questions you should ask yourself. So all of that is out there for you to consider and to discuss your internal process. I should also say that at BDO, we have developed an IFRS 15 tool, also an IFRS 9 tool, an IFRS 16 tool, and these tools are risk assessment tools. And this is tools that we use to sit with you, go through the standard in a structured way, and based on how we answer those questions, we can immediately at the press of a button on the screen show you a heat map for your organization, which could then direct you on which areas for your organization you should do more work, do some position papers before you have the discussions with your auditors. So those are available, and we can speak to you about that. So I just wanted to flag that. There's a lot of free resource, but there's also further things that we can do. If I go back to the slides now and move on to IFRS 9, financial instruments. Now, financial instruments, you will remember when we looked at it last year, three main changes that we discussed, and we did a webinar on each. We looked at the categories of financial assets, we looked at impairment of financial assets, and we looked at hedge accounting, and hedge accounting as recent as December. It feels like a year ago. If we look at categories of financial assets, currently AASB 139 have four categories: fair value through profit or loss, loans and receivables, held to maturity, and also available for sale. And I've also always referred to available for sale as the problem child, and a lot of issues there around good news being reflected in reserves and bad news front and center in profit and loss. We know that that's now being replaced by new categories under IFRS 9. So we've got amortized cost, we've got fair value through other comprehensive income, and you can really treat that as two different ones, because the one is equity instruments and there's no recycling in future, and the other one would be debt instruments where we do have recycling in future, and the fourth one, fair value through profit and loss. I have seen some literature refer to three categories of financial assets because they treat fair value through OCI as only one. And I struggle with that because there's quite different rules around recycling for the two. And I think it's important that you distinguish between equity instruments and debt instruments. And that's why we've treated it as four separate ones. And we talked through that and we did a lot of examples around that. If we move on to impairment of financial assets, again, we spend a lot of time on this. Currently, AASB 139 has an incurred loss model, and the criticism of the model is that we recognize an impairment loss a little too little, too late. IFRS 9 is moving to a model where we're looking at expected credit losses. And what's very important is that it's forward-looking in nature. And we have to take into account expectations around where the macro economy is moving. So if you are building a model to come up with expected credit losses, and it's all based on past experience, there's a big issue with that model. There has to be some forward-looking data overlaid in that. And we have discussed, and we did examples of that, and we said you look at trade receivables, third party and intercompany loans also captured, investments in government bonds, if we've issued loan commitments, financial guarantees. I think what's important, if you look at some of the key features, we said it's forward-looking. We require a broad range of information around, we said the Trump effect and Brexit. Maybe this year it's effect of what's going to happen, close to us in Asia Pacific and Korea. We have to be more responsive to changes in credit risk, and there's a lot of judgment required. And again, how do we document that judgment to withstand the scrutiny of audit? You will remember we also said there's now a three-stage approach. So stage one is where you start, and let's say your credit risk is not increased significantly since initial recognition, and you only recognize your 12-month expected losses. Once you move up to stage two, and you can come up with an accounting policy on when you move to stage two, but there's also a default position in the standard around, more than 30 days past due, you have to move to stage two. And now you recognize lifetime expected losses, but you can still recognize interest income on a gross basis. When you go to stage three is where you've got a credit impaired asset. Again, you can have an accounting policy on when do we get to stage three, but again, there's a fallback position in the standard around 90 days past due. The big thing in stage three, yes, you're recognizing lifetime expected losses, but now you only recognize interest income on a net basis. Now, I particularly like this table, which really flags the two, that when you look at recognition of impairment, there's no huge difference between stage 2 and 3 because it's lifetime expected losses. The big difference between stage 2 and 3 is actually the impact on your recognition of your interest, and that it moves to in stage 3 to calculating your effective interest rate on a net basis. Because once you've hit stage 3, we don't want you to continue to book interest income or interest revenue if we know we're in a credit impaired position. So a lot to get our heads around. And again, we need models, and we have to build models that is applicable for our organization. And then hedge accounting, we talked about it. It's more principles-based. It's less complex. It better links to the entity's risk management activities. In our webinar, we talked about, we still have that difference between economic hedging does not automatically give you access to hedge accounting in IFRS 9. It is easier, but it's not an automatic process. Before we go, sorry, Kevin, we are going to the top 5 things.
Yeah, right. While you were talking, Aletta, I have to admit that I felt like I was phasing out, partly because that's what I get from a lot of people when we talk about IFRS 9. It's a very dense standard. And, when we start talking about expected credit loss and all those concepts, my eyes glaze over, and so do many other people's, and that's a natural phenomenon. It as much as the standard attempts to simplify, it has inadvertently released into the market all these very dense concepts, which appear on face value to be aimed at much larger multinationals, and that is true. But we mustn't forget that every entity that must comply with the standards needs to comply with these things. The best way I can actually just recommend it is incorporate IFRS 9 into your IFRS 15 project. If in many ways the trade debtors, for example, is the other side of the entry from revenue, so you should just look at the two together. A couple of things are changing with IFRS 9. One of the big issues that we run into, and this is for the not-for-profits as well, is unlisted equity investments. Traditionally, if you had an unlisted or an unquoted share, you would just record it at cost. That's actually disappearing under the new standard. It needs to be fair valued. So it's something you want to do right now is if you have those, perhaps that's one you can focus on as an early win on how you're going to value those. Aletta's already covered historical loss information. In order to make judgments about forward expected credit losses based on where the market's going and the geographical spread of credit, you really do need to actually at least have the data on what happened in the past so you can make forward-looking estimates. So maybe it's just a matter of looking, do you know where your bad debts and your provision for bad debts were coming from in the past? Do you have that good quality data that tells you why and whom? Can you stratify it into groups about was it regional or was it a particular type of client? And then the other one, and this is just something we've also picked up, one of the easiest ways to explain the transition of the new standard is to talk about those instruments, especially those with related parties, where you would lend money perhaps to a subsidiary or related party, and there's no interest and no repayment terms attached. That's one that's come up a lot in the last couple of months. Because those transactions aren't basic lending arrangements, what we call basic lending arrangements. And we don't get to record that as amortized costs going forward because we're not actually doing lending. What we're actually doing is providing money which doesn't necessarily have a repayment term. We're not really sure if we're going to collect it. And so it's just a matter of start to have an honest conversation with you about those lending arrangements, because under the new model, what category do they fall into? They're not amortized cost. What are they? Are they fair valued because they effectively become something else other than a basic lending arrangement? So related party loans or transactions without interest and without capital is proving to be somewhat of a nightmare for a number of entities. So those are 5 things you can do right now. Just your unlisted equities. Do you have the data on your past credit losses for your trade receivables, for example? Have an honest conversation with you about what your business model is for your loans. And once again, and this will come up a lot, get some help if you need it, even if it's just a conversation.
we thought it's time for a poll question. Sorry, and I don't know what I've just done. Did I just close it?
That's up.
Oh, it's up. Sorry. Which of the following is relevant to your business? Do you currently have available for sale financial assets, which we said is the problem child? Unquoted equity investments, which can no longer be at cost. It's not allowed at all. Do you have long outstanding receivables, which would require some provision for doubtful debts? Loans to related parties, as Kevin explained, or all of the above? So we're doing a little bit of a risk assessment. So what are we seeing at the moment? What's troubling people at the moment? If we look at the voting, we're moving up around 45%. I think it's quite possible that many of our attendees are dealing with all of the above.
Yeah.
I think those are the things that Kevin and I have been seeing recently when speaking to clients, and that's why we've listed them. Particularly, so that's actually quite interesting, and the results are lining up with what we've expected. So at the moment, we've got 55%. So I'll close 55% voted, and let's share the results.
Yeah, I think the observation is, especially with financial instruments, it's a like I said, it's a confrontational standard. There's lots happening in it. It's very complicated, but perhaps it's just taking a couple of these where we're starting to see the issues and maybe dealing with them first. That can be done really quickly, and you can get a very good strategy adopted on those. 28% or the above. I mean, if you add the other categories together, everybody's going to be impacted some way by the new standard. At the very basic, it's going to be in your expected credit loss model.
So to date, and I mean, it's taken us the first, I would say, 50 minutes talking about IFRS 15 and 9, which are the two standards that is mandatorily effective on or after years beginning on or after 1 January 2018. So we've started with them. If we look at IFRS 16 leases, which is a year later, and AASB 1058 for not-for-profits, we're not going to expand on them that much due to time constraints, but if you look at our calendar this year, we will address them in detail. We're kicking off with the others, though. So as we said for leases, that big change is for lessees, and lessees will no longer account for operating leases different. All leases will be accounted for in the same way, how we currently account for finance leases. There are some exceptions around short-term and low value, but it's very important that we try and determine whether we've got a lease or not. Particularly, some leases are actually hidden away. Leases don't come walking to you and say, I'm a lease, I'm a lease. You enter into a lot of contracts with other people, and embedded somewhere in that contract, you've got a right to use an asset, and therefore you are captured within the leases standard. So it's actually a big exercise to identify all the leases in your organization, and are we appropriately accounting for all those leases? That's a big thing. Then again, we've talked about the reasons for issuing these. I've explained to you, I think it was in last year, January, the webinar on, what it potentially does to profit volatility on net current assets, on EBITDA, bank covenants, declaration of dividends, interest rate cover, debt equity ratio. But the one thing that's really been happening is that clients easily understand the impact of IFRS 16, and therefore a lot of clients want to speak to us about IFRS 16. And we've got some clients who go into a panic attack when we explain this, because they would say, I'm a retailer, I've got 300 leases, or, whatever industry I've got. And this is the leases that call themselves leases. We haven't looked for further ones hidden in contracts. But people are saying, do I have to do all these amortization tables? Do I have to do hundreds of amortization tables? Do I have to do 100 of journal entries? Do I have to employ somebody to do this? There's all these panic attacks happening. Now, this is the one area that we really at BDO have a good solution, and we've come up with, and it's been developed in Germany, a BDO tool that does these. You put in the details and it comes up with the numbers, the journals. They are using it currently for a client that has more than 10,000 leases. So again, it's a lot of work to capture the information, but this tool is also looking at modifications to leases, etc. So again, that's something that we can talk to you about if that's a need that you've got. I think we'll touch on this briefly, Kevin, because
very briefly, we've covered it already. Stop focusing on leases before you focused on revenue. I mean, that's a controversial statement. That doesn't mean ignore leases, but just bearing in mind that the revenue and financial instrument standard comes first. That's this year. The embedded leases in contracts, this is true. I'll go back to the example I used earlier where you've arranged with a customer to deliver their goods for them. Perhaps you've contracted out with another entity to use their transport, to use their trucks on a regular basis. Well, that's technically paying for the right to use an asset, the trucks. So you may have a lease embedded in a revenue contract. But they really could be anywhere. We had a fun session with a client in Sydney at the end of last year, and we did an exercise, write down all the things that you pay money to use, and everything they used, from water coolers to the arts on the wall in the reception area, were all things they were paying money to have there on a sort of a loan basis or a use basis. And then the question was, are all those leases? So perhaps start by making an honest list of what do you pay money to use an asset for somewhere in your organization which doesn't belong to you. And then after that, like I said, there are a couple of solutions there. Do you need a model to capture all your leases? Do you need some help? And in the not-for-profits, which we're not going to cover today, the peppercorn leases, how do you value that right to use?
So if we look at AASB 1058, which is now for our not-for-profit clients, we've spent a webinar on it. We did many sessions with clients on it. A big thing is, first of all, whether AASB 15 or AASB 1058 would apply. We've talked through this decision tree. When would we have sufficiently specific performance obligations? We talked about, if you're within AASB 1058, what are the requirements around volunteer services? What are the requirements if people give you assets to further your objectives? We also stepped through the process where in AASB 1058, you first look at what asset do I recognize? Then you look at, so what is the credit? Is it a contribution? Is it revenue? What is it? And then if there's a difference, to the extent that A is more than B, you end up potentially recognizing immediately. So it's a bit of a process, and we looked at examples and we talked that through. I think the 5 top things for not-for-profit entities, Kevin,
yeah, they mirror the revenue strategies. Actually, Aletta, when we put this together, we realized it's the same process. Stand back and look at how you make your money or how you make your income in a not-for-profit. How does that translate into your grant contracts or the contracts? And then where does that fall into 105.8 or 15? One of the most fun I had all of last year was an afternoon where I spent with a big not-for-profit organization. It's a national not-for-profit, and that they raise a lot of money. There's lots of grant contracts, and we took 5 contracts and we went through the 5 and played with the models, and we had the whole finance team in a room for the afternoon. And 3 of the contracts ended up under 15. One of them went under 105.8, and the other one appeared to be split between the 2. And they decided at that point not to early adopt, but to go back and actually just do a proper assessment over the hundreds of contracts they had. So it's really just don't rush into early adoption. Look at your options. You've got another year to go with this one, so take your time and really just follow the same process.
So next steps, I think what we try to illustrate today is that really it's D-Day. We have to get on to this. We're trying to assist you with the webinars, and we've really spent some time thinking about how can we advance the whole process through the webinars. How can we assist you? So this year, the focus will be, and you would have seen the invitations, it's also on our website. Yes, we look at IFRS 9, 15 and 16. We look at the transitional requirements. So what calculations would be required, what presentation disclosure would be required. And we try and flag next month the complexities around it, because when we did the internal training for our staff last year on transitional requirements, we had to resuscitate some partners. And then we also have a session on risk assessment, and we have to look at some problem areas. We still have our normal webinars, getting ready for 30 June, which we run in May, and getting ready for 31 December, which we run in November. And then I've got a link there to the actual website where you can see recordings, where you can see invitations, everything is there. So today's recording will go up there later today as well. So coming back to, I did warn you, I'm going to ask you, do you need assistance? Do you want to speak to somebody? And therefore, the last poll for today is, would you like Kevin or I to give you a call over the next few weeks? I've said few weeks because I'm a bit concerned that we will be run off our feet. But if you want to speak to us to at least get some guidance on what to do next, maybe you want to talk to us about one of our tools that we've got available, please give us an indication and we are happy to speak to you.
We're also willing to take meetings just to help resuscitate you. That's fine. Aletta and I have become quite good at calming the nerves, and we're happy for those as well. Or we can actually just talk about whether there's somebody in your location, Perth or Brisbane, who can actually help you as well. We do have IFRS people who could actually come to you in those those other regions.
All right. And then the very last thing, I've put in the photos. You can see that Wayne Basford is based in Perth. Clark Gerald is based in Brisbane. Kevin is based in Sydney. Stephen Newman and I are based in Melbourne, and the rest of the team that can work with them. So we would like to thank you for joining us on the webinar. We hope you find it useful, that it's given you some interesting areas to investigate and to follow up. And we'll speak to you again next month. Next month, definitely IFRS 15, how do we do transition? And we'll work through a good example on all the different approaches. Thank you very much and have a good day.
Goodbye.